All right, that was the RBI Governor Shaktikanta Das keeping the policy rates unchanged even as the stance is retained at accommodative. The RBI Governor Shaktikanta Das saying that we're seeing optimism returning as far as businesses are concerned. However, the domestic outlook is clouded by Omicron. Private consumption is still below pre-pandemic levels, and which is why growth is being retained at 9.5%. However, headwinds will continue due to elevated commodity prices. In Q4, we're likely to see inflation peak, even as the RBI has said that inflation will be at 5.3% for 2021-22, with Q4 seeing an elevated inflation risk of close to 5.7%. A whole host of other announcements with respect to how the path to normalization is also going to look like. So let's discuss that in detail. Joining us now on ETNOW is Mr. Sachchidanand Shukla, Chief Economist at Mahindra Mahindra, Mr. Venkatraman Venkateswanra, the CFO of Federal Bank, and of course Nilesh Shah and Mythili Bhusnurmath also joining in. Mr. Shukla, if I can first come to you, and thank you very much for joining in. This is Ruchi Bhatia. Your first thoughts on the announcements that have been made. Clearly, the governor at the moment has been concerned about the Omicron variant. There are a lot of uncertainties to do with that, and it is better that we stay put now and look at any kind of a policy action only perhaps now in February or in April.
Thank you, Ruchi, for having me. Good morning. I think the first word that comes to my mind is reassuring and really pragmatic. I think there is a saying, since the governor has been quoting Mahatma Gandhi, Nelson Mandela, just a quote from Buddha, when everything around you is changing very rapidly, the only thing that you should strive to do is keep yourself unchanged. And I think this is exactly what the RBI has done. This is exactly what the governor has done. We don't know the growth outlook. It's become extremely difficult to separate economics from epidemiology, right? As the virus keeps mutating, so has inflation. So we have to contend with a virus which is mutating very rapidly, and also inflation. I mean, there are so many mutations that inflation has gone through. Supply shock, demand issues, and a mix of these compounded by ever-changing, say, backdrop. And I think we are still several weeks or months maybe before we know if Omicron is the next Delta or otherwise, right? So I think the best thing to do at this point in time is err on the side of caution. We should not allow the effects of Omicron or any other variant to set the agenda for the economy, having done all the hard work through fiscal and monetary policy. And just one last bit before I end is, if you look at the Greek alphabet, Omicron is only the 15th alphabet. Thereafter, there are 9 alphabets. It ends with omega. So the point I'm making is, even with, say, 8 billion plus vaccines, very highly or better vaccinated economies are also undergoing trouble in terms of growth outlook, in terms of inflation. And therefore, vaccine equity and polyvalent vaccines are probably what we need before we can come to any conclusion on the evolution of growth as well as inflation. Back to you.
Right. Nilesh, hi. If I can come to you, what do you make of the path towards normalization as being spelled out by the RBI governor? He has said that by December 31st, large part of the liquidity that is there in the system could be absorbed through the VRRRs, almost 7.5 lakhs by 31st December and almost 6.5 lakhs by the 17th of December. What do you make of these announcements coming in?
So essentially, as Sachin mentioned, this is a reassuring policy. On liquidity side, RBI has been absorbing liquidity to VRRR for quite some time. As of today, current non-controlled liquidity is roughly about 2 lakh crore, which is a significant reduction over the last couple of months. More importantly, they are also supporting growth and keeping a watch on inflation. It's a tightrope walking, but certainly by not revising growth upwards, they believe there is some pressure in economy. Maybe it's related to MSME, maybe it's related to private consumption, which is why they want to continue with accommodative policy. As I mentioned earlier, there will be 3 stages in normalization of path. First will be reduction in reverse repo and repo rate corridor. Second will be change of stance from accommodative to neutral. And third and finally will be repo rate hike. So in this sequence, certainly things will move. When it will move is a question.
9 policies, we've had a status quo 1. Okay, in the meantime, before I take it across to our other experts, I just want to quickly tell you what the equity markets are up to, because while there was nothing new in the policy, the equity markets are holding pat. We're latching on to the gains to 30 points higher for the Nifty futures, 17,450 a print for the Nifty futures. Back on the screen, it's almost 1.5% uptick that we're currently seeing. And today, much unlike the last couple of trading sessions or the many last trading sessions, we're actually rising with the global tide. Remember, global markets as well, extremely supportive and buoyant today. So 180 F&O stocks are standing to the greens with just about 10 to the declines. Persistent, Idea, Coforge, IRCTC, Mindtree, they're all holding up very smartly. Banks are doing particularly well, as was the case yesterday as well. And today it's ICICI Bank, which is actually leading the charts with a 2% bump up. And Bajaj Finance, that's the one which is really topping the charts, along with the rest of the IT pack as well. So Infosys, Wipro, HCL Technologies, all of them holding around 2% again or so. But that said, Mythili, if I could come to you, a couple of key announcements there. Of course, the 14-day VRRR auction, the governor actually talked about being the key tool. He's saying 28 days as needed. But price stability, he says, is going to remain the cardinal principle of the monetary policy. Mythili, what did you make of the monetary policy today?
Well, I just wish the RBI had walked the governor's talk. If price stability is the cardinal principle of monetary policy, which it should be, the RBI should have done much more, not only now, but in the past as well. The RBI has been way behind the curve, something that even the US Federal Reserve, with so many more instruments at its command, with a much smaller section of the population below poverty line, has taken heed of. We unfortunately haven't. Unfortunately, as I said, in this monetary policy, there are clear winners and losers. The winners clearly are the borrowers and the markets. And on the losing side, you have savers, senior citizens like me, and the ordinary Indian citizen, because the RBI itself accepts that inflation is going to peak at 5.7%. We've had negative real rates of interest for almost more than 2 years. And I cannot accept that the governor can really believe that price stability is the cardinal principle when his actions show exactly the opposite. Aisha, I'm sorry I sound a little harsh, but I was really taken aback by the repeated affirmation of his faith in price stability, while the RBI's actions have consistently proved just the opposite.
Okay. Mr. Venkatraman, if I could get you in on the discussion, what is it that you made of the governor's speech today, while, Mythili is rightly saying that to maintain price stability is the cardinal principle, but he didn't really walk the talk?
Yeah, thank you, Ruchi. I think firstly, the governor has been consistent in his approach over the last few quarters. Government has prioritized growth over inflation. The inflation, of course, has gone quite high, and in my view, it's unlikely to subdue in the near future. But the priority of growth over inflation is the approach right now. And if you look at the bank loan growth over the last, say, 7 months, till mid-November, it was about 7%, which is still lower than the 9% CAGR, which we had between 2015 and 2020. So I think the RBI wants to see the loan growth pick up before taking any action on the rates. Like Nilesh said, I think the After the VRR, the next will be the narrowing of gap between reverse repo and then the rate cut, or rather rate increase, not rate cut. So I think the government is watching both the bank loan growth, the capex cycle, which again, private investment is still subdued. And it's a very fine balancing. But like Mythili said, there is a large group of people who are impacted negatively as well.
Sachchidanand, I was a little intrigued by your statement when you said when everything around you is changing, the best thing to do is to remain unchanged. This, in fact, is exactly contrary to what that very famous economist, Lord Keynes had said, that when facts change, I change my mind. What do you do, sir? So do you not think when the facts have changed as dramatically as they have changed over the past year, the least a nimble central bank could do is to, in fact, change, show that willingness to change, rather than remain stuck in the same groove? Sachchidanand.
No, so I just take you back to what I said. When the path of evolution of growth around you is very unclear, and I said inflation is also mutating. It's not as simple as looking at a target robotically and arriving at interest rate decisions. Otherwise, I mean, all interest rate decisions would be outsourced to algos, right? I mean, you just look at a number and arrive at a rate decision. Unfortunately, the world is not as simple. If you look at the evolution of growth, look at how in terms of growth momentum, US growth rate forecast has been cut from 7 to 5.9 even before Omicron hit. Look at the supply side disruptions. These are only going to get acute. We all thought that 2022 probably is going to be a year where, aided by vaccines and vaccination, the worst of this virus or the problem is behind us. It unfortunately is not. We will have to learn, or probably will have to price in this coexistence of the virus in our policy decision frameworks. And the nature of inflation, unfortunately, like I said, you cannot extricate economics from epidemiology till the point when we have a handle on the virus or the evolution or vaccination, or till the last person is vaccinated. We cannot really be changing our growth or interest rate stance. That is number one. Second, in terms of the point on negative rates and all that, I mean, what are we talking about? Look at the Indian saver. We have about 110 lakh crore deposits, roughly. I mean, a very broad number. Nearly half of it is deposits in the banking system. And banks have typically given you 3.5%. And you take the last, say, 2 decades, the decadal average inflation rate has been 6-7%. People have been getting negative interest rates for decades and decades. So I think this entire talk about changing stance very frequently, when we still don't have a handle on the key problem. I mean, how has this inflation problem emanated? It has emanated from the virus. We don't really have a good handle on the evolution. We don't know how virulent it is going to be. We still don't know how bad it can get in terms of mortality. We still don't know how the contact intensive sectors are likely to behave, whether we'll get lockdowns again. So I think when so many things are fluid, it is, I think, very disturbing to think that we can arrive at very simplistic decisions. In fact, we have evidence say globally, and you can look at IMF literature. There is a fine line between remaining patient in the support for recovery, I mean, protecting the downside, and being ready to act quickly. And this is something that we need from the RBI. While strong policy action has tamed inflation typically, I mean, there is a lot of literature and expectations for it. Sound and credible central bank communication has also played an important or crucial role. And therefore, I believe the governor and the RBI have done the absolute right thing by telegraphing continuously that this is going to be orderly, this is going to be the normalization process will be calibrated based on facts. This is not time dependent. This is going to be state dependent, right? So I think all you can do is probably look at maybe liquidity, where they've already started to act, as you know, triple VRRs, some of the other moves over time. And therefore, keeping things unchanged from a policy action perspective is probably the right thing to do. And I stick to my stance that you cannot be changing your stance frequently when you have no clue as to how the growth and inflation outlook is going to evolve over the next 6 months at least.
Agree with you, but when no change, when you have for 9 consecutive policy meetings, I would not calling it a change abruptly. Moreover, the IMF itself has also called recently for a tightening of liquidity stance and a tighter stance on inflation, including in emerging markets. And you spoke of policy, it cannot be divorced from epidemiology. I think the closer connection is politics and economics and policy. So I think let's not get into an argument about this. We could agree to disagree, but clearly there are two sides to the same equation. In fact, I could move to Mr. Venkatraman. The RBI has, talked about this liquidity and keeping stance accommodative. But what difference has it really made to bank credit offtake? There has been a marginal uptick, but that's compared to a very low base. So are we really pushing on a string, Mr. Venkatraman?
Yeah, see, I think, like you said, the liquidity is still quite surplus in my view. It's available. The key is the credit offtake. And like I said earlier, you're still seeing growth, but not at the pace at which we expected it to happen. So it's again, the growth is going to come in, but again, very calibrated. There's been huge deleveraging by the corporates. And there's been a shift to the bond markets, corporate bonds over bank loans as well. So there are those changing dynamics as well. So we are not going to see the credit offtake from the banks in a hurry. It will happen, but again, in a very phased manner.
We're also joined by Mr. Shetty from State Bank of India. Mr. Shetty, pleasure to have you on board. I have two questions for you. The same question that I asked Mr. Venkatraman, whether you would expect to see a bank offtake, credit offtake, because of the easier liquidity stance continuing. And my second question is, the governor talked about a discussion paper on the charges for the payments, the payment systems. Given that you do look after digital banking, what kind of discussion would you like to see around this entire payment space? Mr. Shetty.
Yeah, thank you. I think the first question in terms of the credit growth, one interesting feature what we noticed in the Q3 is that the demand uptick which we see during Diwali and the festival season used to witness a sharp drop immediately after the festival season. But we are not seeing that kind of sharp drop now, which indicates the consumption demand picking up. The credit offtake is improving. But as Venkatraman says, it's not up to the mark what we obviously expect it to be. We see overall the retail growth continues to have the robust momentum. The corporate credit growth, slight improvement, definitely. But as we all know, unless private investment cycle gets into action, the growth may not be really significant. What we have seen in the corporate credit is essentially the improved utilization of the working capital limits, which indicates that the economic activity has picked up. And there have been some proposals, there's credit proposals coming from capex part in metal industry, especially in the steel industry, and also some of the refinancings which are happening in terms of formation of InvITs and infrastructure pipeline which is announced. We see some uptick there, but I think it's too early to say that whether it is a significant one. And as far as the digital payments is concerned, see, on the UPI part, there has been a huge explosion of digital payments. We all know that, but in terms of the fee structure for payment space, I think more or less a lot of commoditization has happened in the payment space. I don't think there is a great money to make. But one idea or one thought which we always have been sharing with the stakeholders has been that there is a significant infrastructure investment which is being made by all the participants in the payment space. So these infrastructure costs somehow have to be taken care of. So whether that discussion paper is going to address this issue or not, so unless we see the paper, we'll not know. I think there is some amount of the rationalization in not only in reduction of the payment, fee structure, it should also incentivize the infrastructure investment in this payment space.
Okay, so that's an interesting aspect that you're talking about the investment infrastructure. Nilesh, if I could turn to you now and ask you, all these months we felt that the RBI was looking at, yield curve management, being a very good debt manager for the government, regardless of what the other consequences are. Do you think now it is willing to put that aspect of its role to a little bit to the back burner, given the improvement in the government's own finances, and also some awareness, hopefully, of the enormous costs on the citizen of pursuit of this policy? Nilesh?
So, Mythili, I will recommend that you start looking at mutual fund schemes rather than just bank deposits. That way, your negative carry and negative rate of return will go away. Looking at RBI, they are managing multiple objectives. It's not just one objective. They are managing inflation, they are managing growth, they are managing currency, they are managing government's borrowing program, they are managing financial system stability, they are managing, the market operations. So whichever thing will require more attention, RBI will put effort over there, ensuring that there is equilibrium. This is probably the only central bank in the world which manages multiple objectives, and we should appreciate them for that.
Sure. Quick take on the markets. We're still latching on to our gains. 17,400 staying put. It's still a triple-digit run that the markets are currently seeing, a solid 200-point gain. And the RBI policy definitely behind us. No surprises there, really. The markets are undeterred. While there are a handful of losers, but I can count only a list of 13 within the F&O segment. Rest all are standing to the greens. IRCTC, Persistence, IEX, Delta Corp, as well as MCX are the ones which are seeing the big moves from within the liquid universe amongst the broader end of the market. But Mr. Shetty, just wanted to get your perspective in over here. At a time when you've got a hawkish commentary coming in from the Fed, they've talked about taper time and again. It seems that the US equity markets have already priced that in as well. It's only going to be a matter of time when perhaps we will have a calibrated move from the RBI too. How soon do you think that could happen when the RBI will have to bite the bullet and perhaps move in on rates?
Not definitely in the next 2 quarters. I think somewhere in the second quarter of next financial year could be, as the governor repeatedly stated in his announcement, what is important is that the recovery is still nascent in Indian context. And obviously, RBI doesn't want to upset the apple cart in terms of the liquidity management, in terms of the policy rates being continued. So I think another definitely 2 to 3 quarters, this momentum will continue. And we need this policy rate stability and also the calibrated liquidity management going forward. I don't think the rate increase in next 2 to 3 quarters.
Nilesh, markets in that sense are averse to change. So perhaps they are liking the fact that the RBI hasn't even talked about moving on rates. But given that you've got a hawkish commentary already coming in from the Fed, and the RBI for now has chosen to kick the can down the road, if I can use that phrase perhaps, when do you think the markets will begin to at least price in a rate stance or a change of rate stance from the central bank?
So there are multiple factors over here. In US, latest inflation number is 6.2%. Last 6 months inflation number, if I remember correctly, it's more than 5%. And their policy rate is at 0 to 0.25%. Now, if Fed is worried about inflation, they better be worried about it because their negative interest rate is more than 5% or 6%. In the Indian context, the last inflation number was 4.48%. Our policy rate is 4%. So compared to Fed's pressure on inflation and negative real interest rate, our pressure on negative real interest rate is much less. Number two, if we look at the bond market, in my opinion, they have discounted probably between 2 to 3 repo rate hikes. The way 1 to 5 year segment is priced today, repo rate could be at 4.5 or 4.75 also, and still the 5-year bond yield will not move. So for an equity point of view, a lot of RBI action is already reflected onto the yield curve. Now, if RBI is able to do an orderly transition, first reduce reverse repo and repo rate corridor, ensure that accommodative stance goes to neutral, and then the repo rate hike happens. And while all these three things is happening, liquidity is maintained adequately, where it doesn't fuel inflation. At the same time, it supports growth. It's a very, very tough balancing act, but for last 20 months, RBI has been doing it. So in some sense, today, equity market is comfortable that bond market is priced in RBI action and RBI will do orderly transition. The third thing is related to taper tantrum, because we have seen large FPI selling in recent time. And part of it could be long China, short India trade as advocated by some of the global broking houses, or it could be related to taper tantrum. My view is that the FPIs eventually will come to India. Today, they are booking profit because India's weightage in MSCI Emerging Market Index through price performances moved from 8% to 12%. When you give 50% outperformance over your peer group, any sane fund manager will book the profit and go back. The Indian and Chinese valuations are probably at all-time high apart. So it's quite natural that some amount of profit booking will happen by FPIs. But to a great extent, compared to 2013 taper tantrum, impact will be limited.
We're just hoping that your words do prove out to be correct as far as all of us in this country are concerned. But I'm afraid it's time for us to slip into a very short break. So let me thank Nilesh, Shachtikanta and Mr. Venkatraman also for joining us in this interesting and lively discussion on the RBI's MPC. Please stay with us. We'll be back in a very short while.